Hey everybody, what is going on? It's Bill with Franklin Loan Center, and so we're getting another episode of The Fed Does Not Control Mortgage. Sorry about that. And so what we're seeing is so the Fed announced another quarter point drop in the Fed funds rate. I've said this a bunch of times. That does not mean that we're going to see a quarter point improvement in mortgage rates. And in fact, today is another example of actually seeing rates go the other direction, right? Now, this is just today's reaction. Who knows what will happen, right? But the market, as I've said a bunch of times, also the Fed funds rate is the only rate that is set by the Fed, just the individual voting members, right? All the other, like whether it's treasuries or mortgage-backed securities or any of that stuff, that's all set by the markets, right? And so the markets get to decide how they're going to react to the Fed, A, lowering rates, and then B, what their comments are, right? And so a couple of things that came out today that were interesting were that the Fed mentioned is, yes, they're dropping rates. They did say there's one more Fed meeting this year, and they said it is most definitely not a foregone conclusion that they're going to drop again in December. So I don't think the market loves that, although like they never are going to announce that they're going to make a decision ahead of time. So, but the market seemed to react a bit negatively to that. And I just think, they're going to run off. They did announce that they're going to start shrinking or stop shrinking the balance sheet, which basically means as what they've been doing as the different bonds are maturing, the different bonds on the Fed balance sheet are maturing, they're just letting them roll off, thus shrinking their balance sheet, right? So now what they're going to do is they did announce that they're going to stop that runoff, which sounds like great news, right? Because then now they're going to reinvest those, so they actually start gobbling up some of that demand that's required out there. So that's the good news. But he did mention that it's going to be on the short end of the curve, right? So then the problem is if they're buying a bunch of 2-year treasuries or 3-year treasuries or 6-month treasuries, whatever it might be, that doesn't help the long end of the curve where mortgages sit. So anyway, it's long story short, the market, the actual markets aren't in love with that today. We're going to see prices worsen just a little bit today. Again, who knows what will happen in the coming days as everything gets digested and as more news starts to roll in. I do think it's really important. And this is the dynamic that is super important. Two things. One, right, keep in mind the government is still shut down. So the data points that the Fed mostly makes decisions off of we haven't gotten really any of them in the last month, right? So most of the stories that they're getting and they're making decisions on right now aren't even based on the federal, the government reports. So I think that's important. And then the other part to that is that they just, the Fed is when those data points continue to come out, we'll see how it pans out, right? So lots of things to think about here, but again, I think the headline here is as I've said before, no, the Fed does not have a direct impact on mortgage rates. And in fact, this is one of those times when we're seeing mortgages go the opposite direction of what the Fed just did. That's all I got today. I'm Bill. I'm with Franklin Loan Center, and I'll see y'all next week.